Welcome to ZZ Financial. We are committed to providing the most accurate, valuable, and timely information and analysis. And wow, what a dynamic morning it is for global finance.
Good morning, everyone, or good evening, depending on where you're joining us from. It's Friday, September 5th. Here on the U.S. East Coast, it's a very early 2 a.m.
Yeah, definitely burning the midnight oil here.
We are. And our friends on the West Coast, they're just wrapping up Thursday at 11 p.m. We've got, well, a whirlwind of financial news to unpack. Everything from, surprising stock market surges to big shifts in economic indicators and some really, really intriguing corporate stories playing out across the globe.
Sounds like a busy night.
It is. So today we're taking a deep dive into these sources, trying to understand what's really moving the needle in today's financial landscape, and importantly, what it might mean for you.
Absolutely, and what a landscape indeed. I mean, we're seeing global markets reacting pretty intensely to some pivotal developments. Let's kick things off with the U.S. market. It seems to be fueling a pretty significant wave of optimism across the board.
Yeah, that's a good place to start.
The Dow Jones Industrial Average, for instance, saw a really robust rebound. It closed up $350 to 45,621. That's what? Its highest level since August 28th.
That's right.
So what's driving this kind of spirited comeback? Especially after, some earlier volatility we saw.
Yeah, that rebound is a very strong signal, you're right. And it's backed by some pretty solid economic data, actually. The U.S. Institute for Supply Management, the ISM,
Right.
they recently announced their August non-manufacturing business sentiment index. Now, for our listeners, the ISM is, well, it's a crucial barometer. They survey purchasing and supply managers across a whole range of industries, so it gives us a real-time pulse on economic activity.
Okay, so it's like a health check for the economy.
Pretty much. And this particular index, it focuses on the huge services sector, so think everything from tech and retail to healthcare, the non-factory stuff. It rose to 52.0,
Okay.
which is a healthy jump from July's 50.1, and importantly, it beat market expectations, which were around 50.8.
Ah, so better than expected.
Exactly. What this tells us, pretty clearly, is that the U.S. economy continues to show, well, remarkable resilience, particularly in services. And that kind of robust health is naturally boosting investor confidence.
So it's not just a single data point then. It's more like confirmation that the broader service economy is holding strong. That kind of fundamental strength, it often has a cascading impact, doesn't it?
It really does.
I mean, the S&P 500 stock index, that key benchmark, even hit a new record high.
Yep, new record.
And the NASDAQ composite, which we know is heavy on tech stocks, closed up almost 1%, 0.97% to be precise.
Right.
Even the Philadelphia Semiconductor Index, the SOX, which people often see as a kind of bellwether for tech, that saw a solid 1.34% gain. Sounds like a lot of green arrows across the board.
That's right, a sea of green. And the strength of the SOX index in particular, it's really telling. It's a specialized barometer just for the global semiconductor industry. It tracks the major companies involved in chip design, manufacturing equipment, all that stuff.
Yeah.
So it's strong performance signals, robust demand and investor confidence in this absolutely critical sector. I mean, semiconductors form the backbone of almost all modern tech, including, obviously, the booming field of AI.
Right, AI everywhere.
Everywhere. And this strong performance in U.S. markets, it isn't just staying in the U.S., it's creating a significant buying lead globally. We're already seeing that ripple effect influencing investor sentiment, even in places like Tokyo.
That's a powerful connection, isn't it, between one specific sector and, overall global market mood.
Absolutely.
And speaking of Tokyo, here's where it gets particularly interesting for Japanese markets, I think.
Yeah.
U.S. President Trump signed a presidential order on September 4th, apparently to reduce tariffs on Japanese automobiles. This feels like a pretty significant policy shift, doesn't it?
Oh, it's definitely significant.
The current 25% auto tariff rate, it's going down to 12.5%, which, combined with the existing 2.5% rate, sets the total tariff at 15%.
It is indeed a very significant development.
Yeah.
And one that greatly clarifies the landscape for Japanese automakers. The order explicitly includes applying mutual tariff reduction measures to Japan.
Okay, mutual.
Yeah, and what's really crucial here is that these measures seem to align closely with conditions Japan had asked for previously. They're quite similar, actually, to the burden reduction measures applied to the European Union.
Ah, okay, like the EU deal.
Exactly. So this reduces a great deal of the uncertainty that had been just hanging over Japanese automakers regarding their export costs to the U.S. I mean, before this, the threat of high tariffs was a major unknown, right? It complicated their long-term planning.
Sure.
Now, with a fixed 15% rate, There's a much clearer operational framework for them.
So this tariff reduction, it basically provides predictability, which, businesses always welcome.
Always.
And how's the market reacting to this news? I imagine Japanese auto stocks must be seeing some tailwinds from this.
Oh, absolutely. It's a strong tailwind. This development is contributing significantly to a sense of buying security. It's pushing the Nikkei average higher. Actually, it's expected to reach around 3,000 yen, which is about 400 yen higher than the previous day's close.
Wow.
Yeah. And automobile stocks like Toyota, Honda, Mazda, Subaru, they're all hitting new year-to-date highs.
Okay.
The reduced uncertainty about, when these tariffs would actually be implemented, that's clearly fueling speculative buying. Investors just have a much clearer picture now of future profitability.
Right. Makes sense.
And it's not just autos. Semiconductor-related stocks are also expected to lead the gains in the Tokyo market, echoing that strong performance we just talked about in the U.S.
That makes perfect sense. Clarity always helps investment decisions, right? Now, let's talk more about semiconductors, because that just keeps coming up. It's like this electrifying theme. The SOX index performance we mentioned, it underscores this robust health and investor confidence. But what's really insightful here, and maybe a key takeaway, is that despite all the intense U.S.-China competition being a big headwind,
Yeah, a major headwind.
the sector isn't just surviving, it seems to be thriving. What does this tell us about the underlying demand and, the future prospects for this really foundational industry? Beyond just general confidence, I mean.
That's a crucial observation, you're right. What it tells us is that the fundamental, almost insatiable global demand for these core technologies is, well, for now at least, it's overriding the geopolitical tensions and the specific challenges.
Yeah.
There's just this persistent, almost exponential need for more computing power, more data storage. This makes the semiconductor sector a powerful long-term play that, investors probably shouldn't overlook. And we're seeing concrete examples of this with companies like Broadcom. Their stock surged nearly 4% in after-hours trading. And what's driving that is, well, it's simply phenomenal.
Okay, tell us more. What's Broadcom doing that's generating that kind of excitement?
So Broadcom CEO, Hock Tan, he announced a truly substantial new order. A single key customer placed this massive order for custom AI semiconductors, they call them XPU.
At XPU.
This order is equivalent to an astounding $10 billion.
Whoa, $10 billion. From one customer.
$10 billion from one customer
Yeah.
for AI chips. Just think about that scale for a moment.
Yeah.
It signifies just an unprecedented level of investment flowing into AI infrastructure right now.
Incredible.
Yeah, and the company is extremely bullish. They're expecting their fiscal year 2026 AI-related sales to improve significantly compared to what they previously thought. Their recent sales numbers were strong too. May July sales up 22% year-on-year, beating expectations. And their forecast for October is also higher than estimates.
Okay.
So this combination of, strong current performance and this deeply optimistic future outlook, it's fueling considerable buying momentum. It really signals that the AI revolution is moving from just promise to, well, massive scale deployment.
That's an extraordinary number, $10 billion for custom AI chips. It certainly underscores the immense demand there. But then we have Kioxia, right? A major NAND flash memory maker. Their stock surged by nearly 19%, up 489 yen to 3,115 yen. What's their story? Is that also an AI boost, or is it something else entirely?
It's not directly AI, no, but it's a fascinating and potent example of how geopolitical moves can create these unexpected market winners and just rapidly reshape competitive landscapes.
Okay.
Kioxia's surge was directly influenced by its joint memory producer, SanDisk, which also soared in the U.S. market. This came right after a major announcement by the U.S. Department of Commerce.
Ah, the government again.
Exactly. The U.S. has strengthened export restrictions on U.S.-made semiconductor manufacturing equipment, specifically for the Chinese subsidiaries of Samsung Electronics and SK Hynix. And these two companies are, two of the world's largest NAND producers, huge players.
Okay, let's unpack this a bit, connect the dots. So, if I'm understanding this right, the U.S. economy looks resilient, that's positive, and the tariff news is like a big green light for Japanese car makers because it gives them clarity.
Right, predictability.
But tell us, what specific underlying trends within that SOX index are signaling this robust health and confidence in semiconductors? What's really going on there?
Good question.
And then this Kioxia story. It's about U.S. restrictions on other companies, Samsung and SK Hynix. How did that actually make Kioxia stronger? It feels like a ripple effect, but almost like a targeted advantage created by policy. Can you explain that mechanism?
Excellent questions.
Mm-hmm.
They really get to the heart of these market dynamics. So first, you're spot on with the U.S. economy and the Japanese automakers. That resilience suggested by the ISM index, plus those record highs for major U.S. indices, it creates this globally positive backdrop.
Right.
And for Japanese car makers, yeah, Trump's tariff reduction order, taking it from that uncertain 25% threat down to a clarified 15%, it just removes a major operational unknown. That predictability lets them plan production, supply chains, pricing with much greater certainty. And that directly translates into investor confidence and, like we saw, speculative buying in their stocks.
Understood. Yeah, that kind of clarity is gold for long-term planning.
Precisely. Now, regarding the SOS index, its robust health signals several key underlying trends. We're seeing continued, almost insatiable demand for high-performance computing. This is driven by, cloud infrastructure expansion and, crucially, the rapidly scaling AI sector. Companies within the SOS index, they're not just selling chips. They're providing the foundational tech that enables everything from advanced data centers to sophisticated consumer electronics. This really broad-based demand, even with the geopolitical headwinds, shows that semiconductors aren't just a cyclical industry anymore. It's looking more like a secular growth story.
Secular growth. Interesting.
Yeah. Investors are seeing past the short-term competition and betting on the indispensable nature of these components for the future of tech.
So it's about the fundamental, non-negotiable role semiconductors play in our increasingly digital world. That's a powerful point.
It is.
And the Kioxia story, that really stands out as a stark illustration of how policy can have these direct, immediate market impacts.
It absolutely does.
Yeah.
So here's the mechanism. Samsung Electronics and SK Hynix are massive players in NAND flash memory.
So huge, yeah.
Their Chinese subsidiaries were previously on what's called the Validated End User, or VEU, list. Now, the VEU list is essentially a kind of pre-approval status. It allowed them to import U.S.-made semiconductor manufacturing equipment without needing individual export licenses for each piece.
Okay, like an easier import lane?
Exactly. But the U.S. Department of Commerce has announced these companies will be removed from this list as of December 31st.
Removed. Okay.
Which means they will now require individual export licenses from the U.S. government for every single piece of manufacturing equipment they want to import into those Chinese facilities.
Wow. So it's not just a restriction, it's adding this layer of bureaucratic friction that could seriously slow down their operations and maybe even their innovation.
Exactly. The implications are significant. These restrictions are expected to tighten the global NAND supply. If Samsung and SK Hynix can't easily get the latest equipment, their production capacity and their tech advancement in those Chinese factories could be substantially hampered.
Right.
And given that they collectively account for more than half of the global NAND market.
More than half.
Yeah. Any disruption to their supply will likely drive up NAND prices. And this is where Kioxia and his partner SanDisk come in. For them, this is potentially excellent news.
Okay.
With potentially higher NAND prices and a constrained supply from their major rivals, Kioxia could potentially increase its market share and profitability significantly. Analysts are even suggesting these restrictions could affect maybe 10–20% of the overall NAND market supply capacity.
10 to 20%, that's huge.
It is. And furthermore, if Samsung and SK Hynix are forced to use older equipment because of these licensing difficulties, Kioxia and SanDisk could gain a significant technological lead. That gives them a competitive edge for years to come. It's a very direct, policy-driven strategic advantage.
That really highlights the strategic implications of these regulatory moves. It's not just about leveling the playing field, it can actively tilt it. Okay, let's pivot now to something that influences, well, pretty much every corner of the market, currencies and bonds. The yen-dollar exchange rate has been quite volatile recently, hasn't it? Hovering around the mid-148 yen range. You mentioned an interesting pattern earlier described as comparing weaknesses. What does that actually mean for everyday people, and why does one employment report from the U.S. cause such a massive ripple effect globally? And how does all this affect something like a government bond, which sounds really stable and safe?
Right, lots to unpack there. Comparing weaknesses is a really apt description of the current dynamic between the yen and the dollar. It essentially means that both Japan and the U.S. currently have their own distinct political and economic vulnerabilities.
Right.
This creates a situation where their currencies become more susceptible to selling pressure during their own time zones. We see this tendency, like you said, yen selling and dollar buying during Tokyo hours, often tied to Japanese news, but then yen buying and dollar selling during overseas hours, often in response to U.S. economic or political developments. For global investors, this adds a unique layer of volatility and complexity. It means those traditional flight to safety moves can be sort of momentarily overridden by perceived domestic issues in either country, leading to less clear directional trends.
So rather than a clear winner, it's like a constant reassessment of who has fewer immediate problems at any given moment. That sounds like a really tough environment for currency traders.
It certainly adds complexity, yeah. For the U.S. side, concerns include, as you mentioned, a potentially worsening employment outlook and rising expectations for a Federal Reserve rate cut.
Right, the Fed cut talk.
Exactly. There are also lingering fears that pressure from the Trump administration could maybe undermine the Fed's credibility, contributing to dollar-selling pressure during those overseas hours. Then in Japan, the uncertainty around the Shigeru Ishiba administration's future, that raises the possibility of fiscal expansion, more government spending, which tends to lead to yen selling. And the Bank of Japan's cautious stance on raising rates early, which was reinforced by comments from a deputy governor about U.S. tariff impacts, that also weighs on the yen. So each currency faces its own specific pressures.
That really connects the political landscape directly to currency movements. It's fascinating. And speaking of employment, we have that critical U.S. employment data release tonight, Japan time. Why is this specific report so pivotal for market direction right now? What are investors really looking for in these numbers?
This data is absolutely pivotal, you're right. It gives us a fresh, comprehensive look at the health of the U.S. labor market, which is often seen as, the engine of the global economy. Investors are looking for signals about inflation and economic growth.
Okay.
Previous reports have shown mixed signals, creating a lot of uncertainty. For instance, July's non-farm payrolls, they fell short of expectations. And the growth numbers for May and June were significantly revised downward.
Right, those revisions were big.
They were. More recently, the ADP National Employment Report for August showed a month-on-month increase of only 54,000 in non-farm jobs, well below the 75,000 expected. And weekly U.S. new unemployment claims also came in higher than forecasts. So these indicators, they generally point towards a slowdown in the labor market.
So the trend seems to be leaning towards a slowdown, which could have big implications for the Fed, right? What are the market expectations for tonight's report specifically, and how might different outcomes really sway investor sentiment?
So market expectations for August include a 75,000 increase in non-farm payrolls. That's slightly above July's 73,000, and they expect the unemployment rate to tick up slightly to 4.3% from 4.2%.
Okay.
However, that general slowdown we've been seeing has already intensified speculation about the Federal Reserve resuming interest rate cuts, maybe as early as their September meeting. Now, if the August employment stats also show sluggish results, say, non-farm payrolls come in significantly below that 75,000 mark, or the unemployment rate jumped more sharply, then concerns about a U.S. economic recession could increase dramatically. And that, in turn, could lead to widespread expectations for a more aggressive 0.50% rate cut from the Fed instead of the usual 0.25%. A bigger cut would signal greater concern from the central bank about the economy's path.
Okay, so a half-point cut would be a big signal.
A very big signal. So ahead of this crucial data tonight, you can expect a wait-and-see mood to really strengthen in the markets after any initial morning gains. Investors are basically holding their breath for these numbers.
That really clarifies the immense weight on the single report. Now, how does all the speculation about Fed rate cuts and employment data impact the bond market? We often think of bonds as stable, maybe even a bit sleepy, but how does this play out there?
Yeah, the bond market is anything but sleepy in this kind of environment. It's extremely sensitive to these signals, especially interest rate expectations. When the U.S. employment data suggests a slowdown, it increases the likelihood the Fed will cut rates.
Right.
And when interest rates are expected to fall, existing bonds that have higher fixed interest payments become more attractive because any new bonds issued will offer lower returns. So the price of those existing bonds goes up, and their yields, which move inversely to price, go down.
Okay, lower yields, higher prices.
Exactly. And we're already seeing a direct response.
Yeah.
On September 4th, the yield on the U.S. 10-year Treasury bond, that's a key benchmark for long-term rates, it closed at 4.16%. That was a drop of 0.05%, and it hit its lowest level in about 4 months.
4 months, okay.
And that decline was fueled directly by those weak employment-related indicators we talked about, prompting strong buying in U.S. bonds as investors sought that safety and higher relative yield.
So effectively, the expectation of lower interest rates makes existing bonds more valuable.
Got it. And what about the ripple effect on other markets like Europe and Japan? Do they just follow the U.S. lead?
Well, the effects are definitely global, but they often have their own distinct nuances. In Europe, for instance, the previous rise in interest rates, which was driven by worries about government finances, fiscal deterioration that seems to have paused.
Okay.
German long-term rates, which briefly got near 2.8%, are now back in the low 2.7% range. French long-term rates also fell. So this led to overall buybacks in European bonds, too, as investors saw relative value compared to where they had been.
Right.
For Japanese bonds, the decline in U.S. and European government bond yields is expected to boost confidence in buying domestic Japanese bonds. That likely causes their yields to fall, too, and bond prices to rise. The yield on Japan's benchmark 10-year government bond, for example, declined to 1.575%. So this interconnectedness means a significant move in one major market, like the U.S., invariably influences others. Understood. So lower global rates make Japanese bonds relatively more appealing. And what about the unique supply and demand dynamics for these Japanese bonds? You mentioned ultra-long-term ones being attractive. What's the story there?
That's a great point. There's a supply factor at play, too. The Ministry of Finance decided to reduce the issuance of ultra-long-term bonds. We're talking like 30 or 40-year maturities starting back in July.
Okay, less supply.
Exactly. And there are no further auctions scheduled until September 17th. So this scarcity, combined with their relatively high yields compared to shorter-term Japanese bonds, supports strong demand. Investors are finding these ultra-long-term bonds particularly attractive right now, precisely because of those higher yields in a world where other rates are generally falling or expected to fall.
And what's the broader outlook for the yield curve in Japan? Are analysts expecting it to keep flattening, or are there other factors we should watch?
Yeah, the general expectation among analysts is for a flattening of the yield curve for Japanese government bonds. That means the difference between short-term yields and long-term yields will narrow.
Okay.
Ultra-long-term bonds are expected to remain attractive because of those higher yields we just discussed. However, there's still caution around short to medium-term bonds because of the uncertainty about when the Bank of Japan might actually start hiking its own rates.
Right, the BOJ timing question.
Exactly. And any unexpected overseas interest rate rises, particularly in those ultra-long-term zones, could potentially delay Japan's yield curve flattening. So it's a delicate balance, really, between domestic monetary policy, global rate trends, and just plain old investor appetite for longer duration assets.
That's really clear. It's definitely not just a fixed piece of paper. It's this dynamic asset responding to a whole global symphony of economic signals.
Well put.
Let's move on to our corporate spotlight now, because companies are making some really big moves. DocuSign, the electronic signature service, saw its stock surge over 7% in after-hours trading. What's driving their impressive digital growth, and how are they keeping up momentum in what seems like a pretty competitive space?
Yeah, DocuSign had some strong news. They announced a significant upward revision to their full-year revenue forecast for the period ending January 2026. They're now expecting between roughly $3.19 and $3.20 billion.
Okay.
That comfortably beats both their previous guidance and what the market was expecting. Their billings outlook, which is a key indicator of future sales, was also lifted, again surpassing market expectations.
Good signs all around.
Definitely. In the recent Q2 earnings, revenue increased 9% year-on-year to just over $800 million, also beating forecasts. Now, a key driver for this strong performance, and this is a strategic shift for them, was the increasing adoption of their AI-powered contract summarization and management services.
AI again.
AI again. It moves them beyond just e-signatures into broader digital contract lifecycle management, which adds substantial value for their customers. And their non-GAAP earnings per share, that's earnings excluding certain non-cash expenses, giving a clearer picture of operational profit, came in at 92 cents, also above consensus. So it's really a combination of strong current performance and an optimistic future outlook, heavily supported by that AI integration, which is expanding what they offer.
AI is clearly a major theme across the board, moving beyond just the tech giants. Okay, another company making interesting strategic moves is Mitsubishi Electric. Their stock rebounded, rising over 3.6%. What's this shareholder-friendly strategy they're talking about, and what does it signal about management's confidence?
Yeah, Mitsubishi Electric is taking a very deliberate, shareholder-friendly approach. It was reported that the company aims to raise its total payout ratio, that's the percentage of earnings paid out through dividends and share buybacks, to a maximum of 70% by fiscal year 2027.
70%? Wow, that's high.
It's a significant jump from their current target, which is over 50%. So it shows a strong commitment to returning capital to shareholders.
Sure does.
And to further improve their return on equity, or ROE, which, measures how efficiently they use shareholder investments to make profits. They also plan to set up a new 1 trillion yen M&A investment framework.
A trillion yen for M&A.
Yeah, big number. They plan to actively strengthen existing businesses while also cultivating new digital-related ventures. Analysts are viewing this as a clear sign of management's confidence. It suggests they're driven by improving earning power in areas like factory automation and AI, and that they expect strong cash flow and growth prospects to support these pretty ambitious targets.
A 70% payout ratio and a massive M&A fund certainly do scream confidence. Now, I'm seeing a fascinating and evolving trend in the bond market, this landscape of ESG bonds with these new, very specific labels popping up, things like orange bond and green nature bond. This feels like a strategic move to attract very specific niche investors, doesn't it?
It absolutely is. Domestically issued ESG bonds, that's environmental, social, and governance, they're becoming increasingly segmented with these new specific labels. It really reflects how issuers are eager to showcase their commitment to sustainable development goals, the SDGs, and also to attract dedicated capital pools. It's moving beyond just generic green or social bonds to very granular, impactful niches.
Can you give us a specific example, like what exactly is an orange bond and why is it important for a company like Itochu to issue something like that?
Certainly. Itochu Corporation, for example, just issued Japan's first orange bond. It's a 3-year ordinary corporate bond, and it raised 15.2 billion yen, actually more than they initially planned.
Okay.
The funds from this bond are exclusively allocated to projects promoting gender equality and women's empowerment.
Wow, really specific.
Very specific. This includes things like building supportive environments for employees, help with childbirth and childcare, for instance, and investing in companies within their supply chains that have active women participation. They cited an example of procuring coffee beans from a Guatemalan subsidiary, where 30% of the producers are female, which is apparently higher than industry peers.
Interesting.
The bond has a 1.11% coupon rate, and it definitely attracted ESG-focused institutional investors. And the principles for these orange bonds are actually set by the Orange Bond Initiative, which is an organization dedicated to financial frameworks specifically for gender equality.
Wow, an orange bond just for gender equality. That's incredibly specific and, yeah, impactful. And I saw something about a green nature bond, too. What's the thinking behind that particular label?
Yes, Nagoya City issued a new ESG bond. It's a 5-year publicly offered local bond, and they designated it as a green nature bond, also the first of its kind in Japan. It raised 10.3 billion yen.
Yeah.
The funds here are restricted to green projects, like installing energy-efficient air conditioning in school gyms, but also nature projects, such as renovating the Higashiyama Zoo specifically for biodiversity conservation.
Green in nature. Got it.
Exactly. Its framework aligns with the established green bond principles from ICMA, but also with the newly established Practitioner's Guide for Nature Bonds that came out just this past June. This helps the city really highlight its commitment to nature positivity. It signals this very clear trend towards greater specificity in ESG financing. And while overall ESG bond issuance volume in Japan actually saw a bit of a decline in fiscal 2024 compared to 2023,
Oh, interesting.
the emergence of these new highly specific labels indicates continued innovation. It's a strategic move by issuers to diversify their funding sources and attract dedicated ESG investors who want their capital to have a really measurable impact in very defined areas.
That's a very clever way to connect finance with tangible social and environmental impact. It makes sense. And Itochu seems to be on a roll because they're also making waves in biotech now. Their stock hit a new all-time high, driven by news about my IP that sells. What's this venture about, and why is it considered such a significant new growth area for a company like Itochu?
Yeah, Itochu's surge was driven by news that the Kyoto University IPSL Research Foundation and Itochu are going to jointly sell a dedicated kit, maybe as early as 2025. This kit is for the low-cost production of MyIPS cells.
Right, IPS cell.
Yeah, meaning patient-specific induced pluripotent stem cells. These are incredibly personalized cells with huge potential in regenerative medicine. The kit apparently combines the necessary reagents and additives, simplifying the cultivation process, reducing costs, and improving yield, tackling some big challenges for mass production.
Yeah.
Itochu is strategically expanding its medical material businesses anyway, things like pharmaceutical packaging, cell culture bags, so they're positioning this venture as a new growth area. Analysts did express some surprise at Itochu, traditionally a trading house, focusing on biotech.
Yeah, it seems like a different field.
It does, but they anticipate significant growth potential as regenerative medicine advances. This kind of diversification into cutting-edge science really highlights their proactive search for future growth pillars beyond their traditional businesses.
From trading coffee beans to developing stem cell kits, Itochu is certainly showing some impressive breadth. Okay, moving on to Exity, a drive system component maker. They also reached a new all-time high. What's driving their appreciation in the market? Is it more than just the overall bullish sentiment?
Yeah, Exity got a significant vote of confidence from Morgan Stanley MUFG Securities. They upgraded its investment rating from underweight all the way to neutral and significantly raised their target stock price from 3,700 yen up to 4,900 yen.
Big jump.
Big jump. The upgrade reflects appreciation for Exity's enhanced shareholder returns, specifically raising their annual dividend forecast for fiscal 2026 from 250 yen to 300 yen per share.
Okay, better dividends.
Right. But it's not just about dividends. Analysts also hold a positive outlook on the company's new business developments. They're venturing into things like two-wheel and three-wheel electric vehicles in India and also emerging drone-related technologies. These new growth areas are signaling a forward-looking strategy that seems to be resonating well with investors.
Good for Exity, embracing new frontiers. Now, on a less positive note, Nidec, a company we often hear about, saw its stock rebound temporarily by 4%, but only after a sharp decline. What caused that initial drop, and what exactly does inappropriate accounting mean? Why does it hit a company's stock so hard, even when the company might seem undervalued on paper?
Right. Nidec's initial decline was due to a very concerning announcement. They found potentially inappropriate accounting practices within the main company and also some group companies. This immediately raised serious concerns over governance deficiencies and the potential impacts on their actual performance.
Okay.
Now, inappropriate accounting, essentially, refers to practices where a company deviates from established accounting principles and standards, basically misrepresenting its financial position, performance, or cash flows.
So not playing by the rules.
Not playing by the rules.
Uh-huh.
And in Nidec's case, the source mentions suspected management involvement, which really elevates the severity. It suggests it might not be just an error, but potentially intentional misrepresentation. And that's critical because, a company's financial statements are supposed to provide a true and fair view of its health to everyone, investors, creditors, the public.
So it's not just a clerical error. It feels like a profound breach of trust, doesn't it?
Exactly.
How does that erode investor confidence so deeply that it tanks the stock, even if the underlying business might seem strong or the valuation looks low compared to competitors?
Yeah, it hits a company's stock hard for several critical reasons. First, it immediately creates massive uncertainty. Investors just don't trust the numbers being reported anymore, so they can't accurately assess the company's true value or its future prospects. This uncertainty leads to a mass exodus, driving the stock price down sharply.
Makes sense.
Second, if management is suspected of involvement, like in this case, it raises profound questions about the integrity of the leadership and the effectiveness of their internal controls. Investors lose faith not just in the numbers, but in the people running the company.
Right, the trust factor.
Huge trust factor.
Yeah.
This can deter new investment for a long time. The company has to rebuild its reputation, implement robust new governance measures. So even if the stock appears undervalued based on a simple metric, like the price-earnings ratio, Nidec fell to around 14 times compared to his peer Mabuchi at 19 times.
Yeah, it looks cheap on paper.
Right, looks cheap. But institutional investors especially will shy away. They have fiduciary duties to protect their clients' money, and they just cannot invest in companies with questionable governance or a history of misrepresenting financials. The risk is simply too high, regardless of that apparent undervaluation, until those deep-seated issues are resolved and trust is painstakingly restored. It's a fundamental blow to confidence that can take years to recover from.
That really highlights how foundational trust is in the financial world. Absolutely critical. On a slightly different note, we're seeing activist investors making waves in Japan. What does this signify about the evolving corporate governance trends there? We saw examples with Kusuri and Fuji Media HD.
Yeah, this trend with activist investors is quite telling about the shifting corporate governance landscape in Japan. Traditionally, Japanese companies have been somewhat less susceptible to activist pressures, partly due to things like cross-shareholdings and certain cultural factors.
Right, it was harder to get traction.
Exactly.
Yeah.
But we're seeing a clear shift now. With Kusuri Aoki, the drugstore chain, its stock rebounded after this Hong Kong-based investment fund, Oasis Management, increased its holdings from just under 10% to over 10.7%.
Okay.
This fuels speculation that Oasis will support movements related to restructuring the drugstore industry. Oasis has previously demanded the dismissal of directors that was rejected, but they continue to strengthen their shareholder presence. It signifies that even when immediate demands fail, activists can keep applying pressure and signal a push for change.
So it's more like a long game for them, keeping the pressure on.
It can be. And then look at Fuji Media HD. Its stock actually declined, despite an investment company linked to the well-known activist shareholder Yoshiaki Murakami increasing its total holdings to over 17%.
It blind, even with more activist buying.
Yeah. While there was some initial buying on expectations of stronger demands for management improvements, selling pressure soon took over. Analysts suggest that without concrete plans for reform, like in its core media content business, or clarity on the future of its real estate operations, which activists often want sold off to unlock value.
Right, sell the assets.
Exactly. Without those concrete plans, the stock price will likely continue to face resistance. It indicates there might be limited room for further buying by the activist fund itself. So what this tells us about corporate governance in Japan is that while activists are becoming more assertive and effective at building up significant stakes, their success still hinges on having clearly articulated, viable plans for value creation that resonate with other shareholders and, crucially, actually pressure management into action. It shows that simply buying shares isn't always enough. They need a compelling narrative for change, especially in industries facing significant disruption.
That's a great insight into the specific dynamics playing out with activist investing in Japan right now. Okay, let's shift our focus to Japan's domestic economic picture and specifically look at real wages and consumption. I saw that real wages are up for the first time in months. Does that mean the average person in Japan is finally feeling richer, or is there maybe more to the story?
That's an excellent question, connecting the macro data to the everyday experience. Regarding real wages turning positive, yes, it's a very welcome sign. On average, it means people's purchasing power is no longer eroding due to inflation, which is good.
Okay, good first step.
Right. However, whether the average person feels richer is, well, it's more nuanced. While real wages did increase by 0.5% in July, it's the first increase in 7 months, following a prolonged period where they were actually falling behind inflation.
Ah, right. Catching up, maybe.
Exactly. So for many people, it might feel more like a pause in their purchasing power shrinking, rather than a significant boost that makes them feel substantially wealthier right away.
Okay, so it's a step in the right direction, but maybe they're still recovering from those previous months of decline.
Precisely. And we also saw that while overall real consumption expenditure for households with 2 or more people increased by 1.4% in July, that's the 3rd month in a row of increase.
Okay.
That increase was heavily influenced by big-ticket items like car purchases, which were up a remarkable 28.5%, and essential services like electricity bills up 11.0%, partly due to an intense heat wave. Healthcare spending also rose 11.5%.
So driven by specific, maybe necessary things.
Some of it is essential spending or larger one-off purchases. Spending on more discretionary items like food, however, actually decreased by 1.8% for the 2nd consecutive month. For example, rice consumption dropped 20% as people shifted to lower-priced blended rice. Confectionery spending also declined, and dining out decreased 4.1%, maybe as people avoided going out because of the heat. And critically, for working households, while their spending rose 4.6%, their real income actually decreased by 2.5% year on year.
Wait, spending up but real income down? How does that work?
It suggests that some households might be maintaining their consumption levels by dipping into savings or possibly taking on debt rather than feeling a true increase in their disposable income. So yes, it's a glimmer of hope that inflation might be stabilizing relative to wages, but it doesn't necessarily translate into an immediate feeling of increased affluence for everyone. The recovery is likely to be gradual and probably uneven across the population.
That makes a lot of sense. The nuance there is really crucial. Now, let's talk about the pet economy. This seems to be genuinely thriving. What makes it so resilient? Even when other areas of consumption are a bit mixed, it seems almost recession-proof sometimes.
The pet economy's resilience is truly remarkable, isn't it? And it really boils down to a fundamental human-animal bond that seems to transcend typical economic cycles. For many owners, pets aren't just animals. They are deeply integrated family members. This means that spending on pets, whether it's high-quality food, advanced veterinary care, maybe accessories, often becomes a non-negotiable expense, even during economic downturns or periods of high inflation. It kind of moves from being discretionary spending to essential spending in the owner's mind.
Like spending on kids, almost.
In many ways, yes. We saw household spending on pet food reach a record 1,047 yen in July, for working households. That maintained a high level after it crossed 1,000 yen for the first time the previous month, and that represents more than a 50% increase since July 2020.
50% increase in just a few years. Wow.
Yeah, and even with significant price hikes in pet food driven by the weaker yen and rising raw material costs, demand, especially for things like cat food, continues to grow because the number of cat owners itself is increasing. An analyst put it perfectly, I thought. Pets are irreplaceable to their owners. This emotional connection creates what economists call inelastic demand. People will often cut back elsewhere before they compromise on their pet's well-being. And this unique dynamic makes the pet sector remarkably resilient to economic pressures that might impact other retail or service industries.
That's a really compelling point, the emotional connection driving economic resilience. It really is a powerful force. Now, looking ahead for listeners wanting to put their money to work, what new investment avenues are opening up in Japan that maybe they should be aware of?
Yeah, there are indeed some interesting new funds launching just between September 8th and 12th that cater to different kinds of investment appetites.
Okay.
First, there's the SBI Alternative High Income Select Fund, launching September 9th. This is apparently going to be Japan's first fund to include private credit that's direct lending to companies outside traditional banking, often offering higher yields. And importantly, it will allow daily purchases and redemptions, offering a lot of liquidity for this kind of asset class.
Daily liquidity for private credit. That's unusual.
It is. It will also invest in more traditional public credits like Western bank loans and high-yield corporate bonds, really aiming for high-income gains. So it offers a new option for investors seeking diversified income streams beyond just stocks and bonds.
Interesting. So for investors looking for alternative income sources with more flexibility, that's a notable development. What else is coming up?
Okay, on September 10th, the Nikkei Europe Stock 500 Index Fund is starting. Pretty straightforward. This fund aims to track the investment performance of a stock index made up of the top 500 companies by market cap listed in developed European markets.
So broad European exposure.
Exactly. For investors seeking that broad exposure without the hassle of picking individual stocks, this offers a simple, diversified option. Then, on September 11th, Sumitomo Mitsui DS is launching its Global Deep Value Strategy Equity Fund.
Deep value. Okay.
Yeah. This fund will invest globally, including Japan, in stocks of companies they deem undervalued relative to their intrinsic value. They use a specific metric, the price-to-tangible book value ratio, which excludes intangible assets like brand value or goodwill from net assets to find these opportunities.
So focusing on hard assets.
Pretty much. The approach is designed to find companies whose physical assets and balance sheet strength aren't fully reflected in their stock price. So it appeals to, classic value-oriented investors.
Those are definitely some diverse options for different investment strategies. Okay, let's turn to perhaps the biggest story dominating markets globally right now, the whole AI bubble narrative and what it means for the future. There's even talk, particularly in the US, of entering a big, beautiful bubble. That phrase sounds both exciting and, frankly, a little daunting. Is this actually a good thing or a bad thing for investors, especially thinking long term?
That phrase, big, beautiful bubble, perfectly encapsulates the current market sentiment, doesn't it? That mix of intense hope and maybe some underlying apprehension.
Yeah, exactly.
So let's tackle that big, beautiful bubble idea first. Whether it's ultimately good or bad for investors in the long run, well, it depends heavily on your perspective, your time frame, and your tolerance for risk. AI-related stocks are, without a doubt, the primary force driving these rallies in both U.S. and Japanese markets. And the view that they will boost the market medium to long term is definitely strengthening.
Okay.
In the U.S., this is fueled by that resilient economy we talked about, plus the strong expectations of a Fed rate cut soon, maybe September. We even saw the KBW Bank Index, which tracks major banks, rise to a record high. That suggests underlying economic strength and maybe low immediate systemic risks, which helps fuel confidence.
So what makes this potential bubble different, or maybe beautiful, as some are calling it, compared to previous speculative run-ups we've seen?
Well, one key factor potentially is that analysts seem to have consistently underestimated the sheer scale of aggressive capital expenditures by the hyperscalers. The massive cloud companies like Google, Amazon, Microsoft.
Right, the big tech players.
Exactly. Current market expectations for their AI-related investments might still be too low. And if that's the case, it makes it difficult to predict when these AI stock gains might actually peak. If these capital expenditure forecasts get revised upward even further, it could continue to justify the current rally, fueling more growth.
So the spending might be even bigger than we think.
It's possible, and we're seeing specific examples that support this. NVIDIA, obviously a leader in AI chips, remains a super strong performer. Alphabet's stock hit a record high, partly helped by avoiding a breakup in that antitrust case, which reinforces the view they'll keep investing aggressively in AI.
Right.
And look at Corning. They make specialty glass and ceramics. They're benefiting from expected growth in AI fiber optic demand for data centers. Their stock is up nearly 50% year to date. The thinking is the fiber optic market could potentially grow 2 or even 3 times its current size just to handle the AI data needs. This suggests a fundamental technological shift, not just pure speculation.
So the massive investment fueling this AI boom is tangible and perhaps still underestimated. But how do current valuations for these AI stocks actually compare to historical bubbles, like, the dot-com era, or even that more recent COVID-driven tech boom in 2021? Are we in dangerous territory yet?
That's the key question, isn't it? According to some analysis, like a Goldman Sachs AI-related basket of stocks, valuations do slightly exceed historical averages right now. However, they remain well below the extreme levels seen during the 2000 IT bubble or the 2021 COVID bubble.
Okay, so elevated but not peak bubble levels yet.
Not yet, according to that analysis. And this is where strategists like Julian Emanuel at Evercore ISI come in with the big, beautiful bubble theory. Their scenario predicts that these bullish trends might face some temporary adjustments, maybe some pullbacks, but without a full-blown recession, and then they can advance even further once the Fed actually starts cutting rates.
Wow.
They project the S&P 500 could reach 9,000 by the end of 2026. It's around 6,500 now, with price-to-earnings ratios potentially rising to 30 times from the current 22 times.
30 times earnings. That's pretty rich. So it's a bubble, but maybe one with stronger underlying fundamentals and perhaps a different trajectory than past ones. Now, I know in Japan, the term bubble carries very negative connotations after their own painful experience in the late 80s and early 90s. How does this beautiful bubble theory kind of reconcile with that historical perspective?
That's a crucial cultural and historical distinction, you're right. While Japan's bubble burst led to decades of stagnation, the infamous lost decades, and a generally very negative view of bubbles.
Understandably so.
Absolutely. In the U.S., however, bubbles are sometimes viewed, perhaps controversially, as a kind of necessary evil, something that spurs massive innovation and investment, pushing technological boundaries and driving progress forward, even if it leads to excess.
A different perspective.
A very different perspective. The thinking is that sometimes you need that speculative fervor, that flood of abundant capital to flow into new transformative technologies to really accelerate their development and adoption on a grand scale. The beautiful aspect of this theory suggests that, unlike maybe the dot-com bubble, where many companies had little or no revenue, the underlying AI technology has tangible, profound applications that are already generating significant revenue and profits for key players.
Okay, so there's real substance underneath, potentially.
Potentially more substance, yes. However, the bubble part always implies that valuations can become detached from those fundamentals, and prices can eventually correct, sometimes very sharply. For long-term investors, the risk is always buying near the peak. If the bubble bursts without a soft landing, even the most innovative companies can see their stock prices plummet, causing significant losses. The key is trying to distinguish between genuine fundamental growth fueled by real innovation and just speculative excess driven by hype. This theory suggests this AI bubble might be more resilient, perhaps correcting without a full-blown recession, but the potential for a painful correction is always there. So you could say it's good for accelerating innovation and potentially good for agile investors who can time it right, but it carries inherent risks for those caught off guard or investing for the very long term at potentially inflated prices.
That's a very balanced and insightful view. It really does sound like a double-edged sword then, but one that definitely has the potential to reshape our world.
Now, how is Japan benefiting from this global AI surge? Are they primarily just supplying components into the US-led boom, or are they developing their own AI solutions and applications too?
Japan is clearly benefiting, particularly with those AI-related stocks we mentioned earlier, Advanis, TDK, Fujikura remaining in high demand. These companies often play crucial roles in the semiconductor and electronic supply chain that enables AI.
Okay.
For example, Advantis is a leading provider of semiconductor testing equipment. That's absolutely essential for ensuring the quality and reliability of these incredibly complex AI chips. TDK is known for its electronic components, capacitors, inductors, sensors, which are vital for power management and other critical functions inside AI servers and devices.
Right, the crucial bits and pieces. Exactly. And Fujikura, which we noted hit a record high recently, its stock has more than doubled this year. That's driven by growth in high-density fiber optic cables needed for data centers, and this broader industry shift from copper wiring to fiber optics inside AI servers themselves, because they just need to handle enormous amounts of data at lightning speed.
Makes sense.
Analysts maintain an overweight rating on Fujikura, citing strong fundamentals and those upward revisions in hyperscaler capital spending forecasts we talked about. So while the U.S. might be leading the charge in the big, beautiful bubble narrative, particularly in terms of software platforms and maybe the most cutting-edge chip design, Japan is playing a significant and arguably indispensable supporting role. They're providing the high-quality, high-performance infrastructure and components that actually power this revolution.
So Japan is like the critical enabler, providing the sophisticated parts and the essential infrastructure for the whole AI ecosystem.
That makes sense. But what about the broader Japanese market overall? Is the Nikkei still seeing those massive gains fueled by this, or is there a sense that maybe things are hitting a bit of a plateau?
Well, the Nikkei average did briefly surpass 43,000 yen, rising over 600 yen temporarily at one point. But it seemed to struggle to extend those gains, and it closed the morning session up only about 310 yen. That indicates some resistance at those higher levels.
Okay, hitting a ceiling maybe?
It suggests we might be entering what analysts call a consolidation phase. What that means for investors is that prices tend to move sideways, kind of within a defined range, rather than making significant new upward or downward moves. We've also seen trading volume on the Tokyo Stock Exchange prime market trend downward since late August, which is also often characteristic of consolidation.
Now, while there aren't any major immediate negative factors hanging over Japanese stocks, the market seems to have already largely priced in that expected Fed rate cut. And existing domestic political uncertainty, specifically around the upcoming LDP leadership election, that remains a significant factor kind of limiting the upside potential. So additional positive catalysts will likely be needed for Japanese stocks to break out of this consolidation phase and push significantly higher, maybe surpass previous all-time highs.
So a bit of a wait-and-see mood then, with investors looking for something new to really ignite further growth. And speaking of domestic politics, you mentioned some uncertainty there that could affect the markets. Can you elaborate a bit on the specific political events people are watching and their potential impact, particularly maybe on bond yields?
Yes, domestic political events are certainly on the market's radar right now. Markets are closely watching for confirmation regarding an interim leadership election to move up the Liberal Democratic Party's presidential election. That confirmation is expected maybe by September 8th.
Okay, soon then.
Yeah. Now, if Prime Minister Shigeru Ishiba, who is generally seen as emphasizing fiscal discipline, were to resign due to calls for accountability, well, overseas investors might anticipate a shift. They might expect potential rate hikes sooner, or maybe fiscal expansion increased government spending from a new administration.
Right.
And fiscal expansion, meaning potentially a larger national debt, could put upward pressure on Japanese government bond yields, as investors demand higher returns to compensate for perceived fiscal risks. Higher bond yields, in turn, can make equities look less attractive by comparison, potentially acting as a drag on the Nikkei.
So political stability and fiscal policy are really deeply intertwined with market sentiment and bond yields there.
Very much so.
And there's even international political risk, adding another layer of complexity, right? How might a political event happening far away, say in France, actually ripple out and affect global markets, including the Nikkei right now?
You're absolutely right to highlight that interconnectedness. It's not just domestic politics. Coincidentally, France's Beirut cabinet faces a crucial confidence vote, also expected around September 8th.
Same timing. Interesting.
Yeah. If it fails, which seems likely according to reports, it could lead to political turmoil in France, possibly a new prime minister, maybe even a snap general election. The concern for markets is that a new, perhaps less stable cabinet might struggle with spending cuts. Or worse, you could see an expansion of government spending, especially if leftist critics join the opposition and push for more populist policies.
Okay.
That kind of fiscal expansion in a major European economy could put upward pressure on French bond yields. And because European bond markets are highly integrated, that impacts German yields, Italian yields, etc. And because global bond markets are so sensitive to each other, a rise in French and European yields could make all government bonds, including Japanese ones, seem relatively riskier or just less attractive compared to their yields.
Wow. So even though it's happening far away in France, a political shift there can still create this ripple effect that touches Japanese investments.
Absolutely, especially when the market is already in a consolidation phase, like the Nikkei seems to be. It needs strong, positive catalysts to break out. Political uncertainty, whether it's domestic uncertainty in Japan or international uncertainty originating in France, tends to act as a negative catalyst, or at least a dampener. It just reinforces that wait-and-see approach among investors, making it harder for the market to gain decisive upward momentum and potentially prolonging this consolidation period. It's a powerful reminder that even seemingly local political events can have a significant global economic echo, influencing investor behavior and market direction far beyond their borders.
As we bring this really detailed exploration to a close, it's just so clear we're navigating a fascinating and incredibly complex financial landscape right now. From the just incredible momentum of AI-related stocks and those ongoing ripple effects of U.S. tariff policies to the subtle shifts happening in global bond markets and that intriguing evolution of ESG investments, there's just so much to keep an eye on.
There really is constant motion.
Yeah, the market is constantly weighing new data, everything from employment figures to corporate earnings reports, and it just reminds us again and again how truly interconnected our global economy is. The key takeaway, I think, for all of us listening is that understanding these intricate relationships, both at the big macro level and down at the company-specific micro level, is absolutely essential.
Couldn't agree more.
And maybe here's a final thought to ponder. As AI drives this unprecedented amount of capital into new technologies, are we witnessing a fundamentally new kind of economic expansion, something truly different this time? Or is it perhaps just a more sophisticated echo of past speculative booms, just waiting for its own unique, maybe AI-driven correction down the road?
That is a truly thought-provoking question, and one we'll definitely continue to explore in the future. Thank you, everyone, for joining us for this deep dive into the latest financial developments.
Thank you for joining us on ZZ Financial, where we are committed to providing the most accurate, valuable, and timely information and analysis. Until next time, stay curious and well-informed.